for so that was good. So for now, we were going to talk about car purchasing. We thought that would be a nice little palate cleanser. So I just want to talk about some simple stuff. So when you buy a car, right, you can buy it with cash or you can buy it by taking on a loan. Okay. There are a couple ways you can take car loans. You can either take a personal loan, all right, cash loan, which would be a personal loan, um, or you could take a title loan, which would be a car loan. So with a personal loan, you go to the bank, you apply for it, you qualify, they give you the cash, they give it to you in cash, right, or deposit in your account. So the benefit is you can spend that cash however you want. You don't have to spend it all on the car. You can spend part of it on the car, whatever.
So if they gave me a loan
Yeah.
that's a cash loan for $20,000 and I buy a $15,000 car, I can do whatever I want with the other $5,000.
Right. Anything you want to do. And you can get more flexible payments with a personal loan than you typically can with a car loan. You can do most of them are 12, 24, 36 months. You can go longer, but then you'll end up paying a lot more in interest payments.
So let me interject
before
we go into cons here. So another term for a cash loan might be a signature loan.
Mm-hmm.
When I worked in banking, they often called them signature loans because the only thing required is your signature.
Right.
They're not holding the title to your vehicle, or like with a mortgage, they're holding the title to your mortgage. It's literally like with a credit card, it's just your signature, and they're not holding on to anything of yours. There's nothing securing it. Mm-hmm. So it's not secured, and you're basically just signing for it. So that is, you could call it in the pro column that you're not necessarily having any of your assets held in order to secure that. And I just wanted to conceptually put that out there.
Right.
That it's like that. Where it's different, obviously, from a credit card is it's not revolving, right? It's just a set amount when you do these types of loans. But the similarity being that there's no asset of yours that's securing that.
No, typically not. Sometimes you can do a personal loan where you have an asset securing it, but most of the time it's unsecured.
But it's
rare.
Not typical.
Yeah, it's rare.
Because otherwise they'll shuffle you into a different loan type generally.
Yeah. So but it's an unsecured loan, so there's nothing securing the loan, right?
Typically.
Yeah. For the bank, at least. So the cons are generally they have higher interest rates. Not always, but usually. Lending requirements tend to be a little bit tougher. You usually have to show taxes and show you have a job and all that stuff.
Again, because they're not securing it with anything on their end, right? They need to protect themselves by making sure they only qualify people they're really sure about.
You can pay. So like poor credit usually won't qualify. So you have to have good credit usually. Most people take out a title loan or a car loan. Okay. And then you can get those from the bank. You can get it from the dealer sometimes, but usually people get it from the dealer. But those loans work like that. I mean, they work like this. Instead of giving you cash, the bank buys the car and the bank holds the title until you pay off the loan. So that you don't really own the car, the bank owns the car. And then when you pay off the loan, the bank gives you the title and it's your car. The pros of this is that you get a lower interest rate because the bank it's a secured loan because they can always take the car if you don't pay. It's easier to obtain these with lower credit scores. And it's more convenient to get financing because you don't have to go jump through a lot of hoops, right? The negatives is you don't have the title of the car, so it's not really your car, and it usually requires sort of an upfront deposit from you. So you usually have to make a down payment. Not always, but usually, right? Now, the benefits of this, and I wanted to get into this, is car loans tend to be simple interest versus compound interest, which is nice. So credit cards are compound interest kind of debt. So if I don't pay it off, right? The interest that accrues will accrue more interest. So it's exponential growth, right? So it's compound over time. As where with the simple interest loan, the interest does not accrue any more interest. You can only charge interest on the principal, the amount you borrowed. So it becomes a real simple payment structure. So I just did a real easy one here. So if I took out, let's say, go ahead.
Let's just pause on this for a second. So when you're saying that, what you're saying is in a car loan, when the interest hits, it doesn't get piled on top of the remaining principal.
Right.
That's what happens on my credit card, but that's not what will happen on
This.
my auto loan.
Right.
So I'm still only going to pay interest on the original principal, and then obviously it's gone down a little with my payments,
right.
but they're not going to pile more interest on top of that I pay interest on.
Right.
That's what you're saying.
Yeah.
Okay.
So they're a little bit safer for as far as loans go. Now I just did a simple example, right? So simple interest, not compound. Example: let's say I bought a car. It was $45,031, and I did 10,000 or 10%. Sorry, down payment. So I paid $4,503. So the amount I financed, I loaned, was $40,528. So my loan payment, my simple interest payment would be $746.38 a month. That's what I pay on that car for. Let's say this would probably be like a 5-year loan or a 6-year loan. Oh, 5-year loan. Sorry. Yeah, but in compound, let's say I didn't pay this, I couldn't pay it 1 month. The interest that accrued on top of that would then start accruing interest on top of that. As where with a car loan, if I don't pay it 1 month and I catch up the next month or something, it doesn't accrue interest on the amount that accrued. So
it's not making it more expensive for you.
No.
In that situation. No. It doesn't change the amount that you end up paying.
No, I still pay the same amount. It doesn't really alter it. So that's that. So those are the kinds of the ways you can finance a car. You can do a personal loan, car loan. You can pay cash for the car. Kind of whatever floats your boat, whatever your situation is. The next things about owning a car, which is really important, is car insurance. Because it's the one thing I think people kind of forget, right? Because that's another cost to having the car, is you have to have car insurance. Liability insurance is mandatory in every state. So I'm going to go with, these are the 6 types of car insurance that you'll face, or that are offered. So liability, everybody has to have liability. Liability is bodily injury and property damage, but not to you, only to things that you cause to another person, right?
That's why people sue you when you hit them. Right.
So if I am driving along, right, and I've got my liability coverage, and that's all I've got, I just have my mandatory coverage. My the low interest car loan stuff that they always pitch on TV. Get your car loan down and da 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 da. Well, what they're doing is they're cutting your coverage. So I'm driving around. I just have liability. I run into Lacey's car. And Lacey's in her car. And Lacey gets hurt, and I get hurt, and there's a lot of damage to both cars. My liability coverage will cover Lacey's injuries, probably, and damage to her car, but it won't cover any damage to me or my car. So that coverage doesn't cover me. It covers something I do to somebody else.
Right. It protects other people from you.
Right. So liability is what's required by law. They're required that you protect other people from yourself, kind of thing. So other types of insurance that you should consider: uninsured or underinsured motorist. Okay, this is if I'm hit by somebody who doesn't have insurance or is underinsured. And some states do require this. And this is important because, let's say I'm driving and I hit Lacey, same scenario, but I don't have insurance. I'm driving without insurance, lawfully, right? And Lacey's got medical bills now, and she's got damage to her car, and she can try to sue me, but I don't have any money. So What's going to happen to Lacey? Well, Alacius has uninsured, underinsured coverage, so her
Which
insurance
means my insurance company
will cover the damage.
is going to be covering my tab.
Right. For my damages.
Right.
So that's a good one usually a good one to have because it does happen. Comprehensive coverage covers things: theft, fire, hail, vandalism, stuff that happens to the car that otherwise you wouldn't think about, right? Um, it does have a deductible, meaning you have to a deductible, for those of you who don't know, is if it's $1,000 damage to the car and you have a $500 deductible, that means you have to pay $500 in cash, and the insurance will pick up everything above that. So if it's $5,000 damage, you still pay the $500, but the insurance will pick up above that to whatever their limit is.
Right, and one of the selling points on these deductibles is the high amount of coverage that gets offered once you've satisfied the deductible, but they will change what your monthly payment is based on how high of a deductible. So there could be kind of this game you're playing here of how high of a deductible can I afford, because my monthly payment, if I choose the $1,000 deductible, is going to be cheaper. But then I have a $1,000 deductible, so that's kind of an evaluation that people have to sort of make.
You have to figure it out, and I think it would too depend on the car, right? So if I have a beater car and I want to get comprehensive insurance, I don't know why I get comprehensive on a beater. It probably wouldn't matter. But let's say I had a lower price car, like I bought a really nice used Buick for like $10,000, right, from my friend, and I wanted to get comprehensive coverage on it because I like the car. Well, let's say the car gets damaged, a tree falls on it, right? If my deductible, and it's $2,000, my deductible's $1,000, right? My monthly payment would probably be whatever, 50 or $60 for that extra comprehensive, right? But then I'd have to pay the $1,000 to get $1,000, right, to cover the car. Now, if I got my deductible down to like say $250, I get $1,750 to cover. I pay $250 and I get $1,750 to cover the damage. But my deductible payment would probably be close to like $100 a month, or 110, whatever it is. So once again, it kind of depends on how much you want to cover the car. So Lacey made a good point there. It's just how much you really got to kind of weigh it. If you've got a really expensive car, you might want to get a lower deductible. It might be worth it.
There's also an element of considering, what kind of vehicle you have and how expensive parts are for it, because some types of vehicles, it's more expensive to need to order certain parts for it than others too. Right. So knowing that kind of thing about your vehicle also can be helpful in making that decision in terms of how much coverage and what sort of deductible level you're comfortable with.
Right. And I want to cover this too, especially for younger people. Let's say you have $1,000 deductible and $2,000 damage is done to the car, right? The insurance will not cover the other $1,000 until you've paid the deductible. So you have to have $1,000 available to pay for that before the insurance will cover the other $1,000. So you got to make sure you can cover your deductible.
So this becomes an important point in terms of planning for your emergency savings within the rest of your personal finance situation, right? Because if I know I've chosen a deductible of a certain level, I need to make sure that my emergency savings always at least has that amount in there, because if I end up with a situation where I need to be tapping that insurance, then I want to make sure I can get paid right away.
Yeah. Well, this is one thing, and we'll go back to the Money Guy stuff that they do that I really like, that I thought because they do a lot of really smart things. And one of them is their whole thing is that your emergency savings should at least cover all of your deductibles of your insurance. And that's a real smart thing, because at least you're covered then if anything happens. So it's a really...
And if those things happen in combination, right?
Yeah.
Like if I have the car thing and a medical thing happening at the same time, and I have two deductibles I need to meet, and then God forbid we throw in a dental thing, and that's got some sort of a thing to it too.
Right. Yeah. And then your house catches fire, and you never know. When it rains, it pours.
Unfortunately, I hate to just say things about luck in particular, but sometimes bad luck happens in multiple, iterations before it's done.
Oh
So,
yeah. Oh yeah. No, it can happen in spades.
yeah.
This slide came out funny. Oh well. Anyway, so this is the other three. Look at that. I don't know why they came out different. That's weird. Anyway, so the fourth would be collision. So that would be anytime you like an accident with another vehicle or object. They can repair or replace the car after you pay the deductible. Lenders can require that. So that's not always a bad one to have because sometimes something hits your car or you hit something.
So it will cover your own car.
Well, and it'll
not
actually
just
it
somebody
covers
else's, right?
no, it just covers your car,
Okay.
and
So you have to make sure your own car will be covered regardless.
and you got to check it because it'll repair the car or they can replace the car up to the fair market value of the car. So if your car gets totaled, collision will replace the car, or at least repair the car back to where it was up to the market value. So I mean, you're not going to be without a car. So collision's a pretty good one to have. Medical payments are a good one to have. It covers you, any passengers in your car, or any family members, and that includes people you're living with. So if your boyfriend, girlfriend, spouse, whatever, if they're driving your car for whatever reason, their car's in the shop, right? It covers some of their medical costs. But yeah, it covers a lot of the medical payments, and some states require it. The last one's personal injury. Only a few states have this. I don't know how many. It's like 10 or 12 have it, but this will cover also things like if somebody gets injured, medical costs also, but it'll cover childcare costs if they can't take care of their children and they have to send them to daycare. It'll cover loss of income from if you can't work. So it's comprehensive on that. So it's not a bad thing to have. It's just it's just if you can get it, right? So yeah, so those are the types of insurance. Now, don't we all feel much safer and better that we know that? I know, sexy stuff.
You know what? It might not be sexy, but it can be a little bit confusing because there are some of those types of insurance that sound like they're doing similar things, but there are key differences that are kind of important to note. So I do think kind of going over that is important.
Okay. What I did want to cover too is this. So Lacey does a lot of teaching on budgeting and how to do different budgeting strategies. So gas and maintenance and car payments, all these things go in. So buying a car adds a lot of things to your budget, and it's important. Several payments to think about. So if you'd be kind enough to elaborate a little bit about kind of what the different things that are added when you buy a car to your budget and kind of how you should think about those.
So I tend to think about it in my mind as roughly 4 different payment categories have been added to my life, some of which are more, periodic, right? So we obviously have the car payment if we didn't buy in cash. Right. So we have the car payment, and then we have the insurance payment, which we just discussed. Right. And then we have the gas payment, which is a series of payments, right? Unless you have a gas card or something you're using and paid at the end of the month. Right. But you have to pay for gas and the maintenance payment, and people leave that part out of their budget so frequently, and that's how they end up getting into debt. So it's absolutely critical that you budget something every month. I am a huge advocate of having multiple savings accounts. Organize your life how you like, but I really like having a separate savings account for things. Have one that is for maintenance, where you set an amount and you transfer into it every month so that you are covered when that happens. Because inevitably, there are going to be things that need to be repaired and just general maintenance that's going to need to be done. Right. Generally speaking, and you can go watch our video about budgeting that we have done.
Shoot. Sorry. Go ahead.
Feel free to go and watch that so you will be able to understand more clearly what categories I'm talking about. But within the budgeting system, I like to use the 30-50-20 budgeting plan. I put all of those generally under my flexible flexible spending category. I don't usually put that stuff under fixed. Some people might put their car payment under fixed, but it's easy to refinance and alter that. I put them under flexible because I feel like
Let's go. It's
I feel like you've got
kind of how you want it, how you feel like you should do it, kind of thing.
right. Some people want to put it under their fixed expenses, but I also have a lot of clients that refinance them so they can get them taken care of sooner, or this and that. They futz with them. So
yeah,
put it into which category you want. All of the other ones are very clearly just going to park under your flexible category.
Right. Yeah. Well, cool. Yeah, and then calculating gas is one of those things I think people get because it's always in the news, right? Gas prices are up. Gas prices, inflation, whatever it is. And it's a big deal because if you work and you have to rely on your car, so kind of what I always kind of recommend on that is get a good sense. This is, I mean, if you're one of these people that wants to do this, because I used to drive a lot for work, because I would go to give meetings and presentations all the time when I first started out as a financial advisor. I mean, you're rarely in the office. Your office is your car because you're driving around to all these different businesses and places, getting clients presenting. So I factored in, okay, well, what was the mileage in my car? So you have the little button, right? You fill up your card, you hit the little button to 0 to track the mileage. And then when you get down to nearly empty and you refill, okay, I got X amount of miles off of X amount of gas, right? Or X amount of gallons. And then you divide it and you figure what the gas price is. So I'm getting whatever 30 miles to the gallon, right?
Mm-hmm.
So, and I'm going this many miles a week on average. And then you figure it out. So I kind of figure, okay, well, this is what I figure I'm going to need. Let's say 20 gallons of gas every week, which is a lot. But I'm just giving you an example from my background because I drove a lot. So if I need 20 gallons of gas a week, and gas is $4 a gallon, I'm paying at least $80 a week that I got to budget for gasoline in the car. But now if gas has gone up to $6 or $7, it's like, right now I'm like, oh my gosh. So now that $80 is like, oh my gosh, now it's 120 or 140.
Right. That's where it definitely needs to be in the flexible part of your budget, because not only does the amount you drive potentially change with the things going on in your life, and the price of gasoline also changing. So yeah, that goes up and down for sure.
Yeah, but it's one of those where if you rely on, I know I'm going to drive at least this much, right? You got to be prepared for, gosh, if it goes up $1 a gallon, it's going to start to get expensive. It's just why I understand everybody complains about it, and you can blame the president and all that stuff, but it's a lot of it has to do with OPEC and other things going on in the world.
Right, they think the president's in control of the gas prices. I mean, come on.
Wouldn't that be nice, though? Gas would always be like...
I kind of feel like the president would make the gas prices significantly better.
Wouldn't matter what president it was. If they could control it, it would always be $2 a gallon. Right? Because they want to get reelected.
All right, this is a weird to the side, but I have to say this. Did you know that in Venezuela you can get free gas? There are 2 different types of gas stations. One of them is the free gas station. You'll wait in line for that thing literally all day long.
Right.
But it's the free government gas.
Right.
Versus there's the gas that you can pay for.
Right.
I'm guessing the reason you would go there is the shorter line, probably.
Right.
But then, the crazy prices and stuff there.
Yeah. Well, the other thing too is people don't understand is most gas stations, they don't make that much money on selling gas because the prices are so transparent everywhere. It's barely marked up, so they're not making that much money on the gas. So even if it's like, oh, it's $6.50, right? The gas station is probably paying $6.40 per gallon, so they're not making hardly anything. So most gas stations make their money on you going into the convenience store and buying
the coffee or
the candy bar, which is
the candy bar
which is
whatever.
marked
Yeah.
up by 2,000% because they bought that Snickers bar for
Buying the cigarettes, the beer.
right.
Yeah.
Oh, the cigarettes especially. So they got it for probably $2 or $3. You're paying $10 for those cigarettes, right?
That's why all gas stations sell cigarettes, and they're probably not going to stop anytime soon because they're not making that markup on the gasoline.
Oh, and candy bars, they're charging you $1.25 or $1.50. They're probably getting them for 20 or 30 cents. So
right?
yeah, they make all their money. You'd be surprised.